Let's turn back to the advisory now with the do's and don'ts in terms of property investment. Helen Baker is joining us, from a financial advisor and founder of On Your Own 2 Feet. Helen, welcome.
Thank you.
All right, so of course we're heading towards the end of the financial year. Now, for property investors, what are some of the considerations you need to have?
Well, we all know we've got to do our income and our expenses, but I think what we need to think about is the timing. So if you take your property manager's sheet, you might find that they're not as accurate at what's happening in your bank account. So you might get, for example, June payments falling into July, but you're counting them in this financial year, and you shouldn't be if you're doing cash accounting. So just got to understand, when is the timing, when does this land in the accounts, and is it better for it to land in the account this year or next year, depending on what you're earning?
All right. Do you also need, well, you haven't got much time left, but do you want to rush those expenses through before the end of the financial year?
Yeah, you're right. We're running out of time, aren't we? So yes, if it makes sense to do so, but you can look at prepaying interest, for example, if that makes sense. So it depends on what your year was like. Did you have a successful year, or was things tight? And do you push it into next year when there might be a better year? It's all about understanding those timings, but they obviously have to correlate with what actually happened as well.
Yeah, well, I guess it often comes down to, as you mentioned, whether you had a good or a bad year in terms of property investment, whether you're negatively geared or whether you got positive cash flow.
Yeah, exactly right. And also thinking about repairs versus renovations. Often people get caught up with claiming these things as repairs, but they're actually not. They're a renovation and what's called a capital expense. So making sure you've got your depreciation schedules up to date as well. Make sure you maximise those, because that declines over time, obviously, and then you lose any future depreciation. So making sure that you've got a new schedule, it's up to date, and making sure you're entitled to what you're entitled to.
Yeah, is that a must, a depreciation schedule then?
I think it is. Certainly when you generally buy a new property, you'll get more depreciation at the start, and then it will decline. If you've had a property for a very long time, it will generally have run out unless you have done something significant to the property. So I think they're things that people go, oh, I didn't know it had run out, or haven't checked with their accountant about those things. So it's important to get on top of those as well.
If you're in a strata, does that simply just, well, not simply, but it actually complicates issues, doesn't it?
It does. There's the good old body corporate fees, which is always a bit of a thing, and they always come with challenges as well. And that's also something you have to think about. Do you need to plan to put some money aside for upcoming big expenses that happen? You know, many organisation, a body corporate will have issues with roofing or something like that, and it's not covered in your sinking fund, and you've got to put money into that. So there's really got to be some good planning for the next 12 months around what your commitments will be.
What if you're a potential property investor and you're looking to buy? What do you need to consider, do you think?
Yeah, that's a good question, isn't it? I think now, depending on which state you're in, which town you're in, where you're looking at, you will get very different experiences with the property market at the moment. Some have gone up a lot, some have fallen, and then you've got to pair off the rental success of those. Is the rental increasing? How does that work out with all the other expenses? So I think it's always about crunching the numbers, and certainly plan for interest rate rises. It might not happen for a little while, but it's really good to ensure you've got a plan around that, because this is where we see people have got caught in the past. They've committed to something at an interest rate and it's exceeded that over time, and then they're really struggling.
Well, in fact, we're now in an interest rate cutting cycle.
Yeah.
But still it could be a trap, can't it? Because you overextend and then before you know it, they're on the march again.
Yeah, and you could fix, for example, so you could end up in a fixed rate, and then they continue to fall, and you're paying all this extra interest that you wouldn't have had to have paid. So do you look at a mixture between fixed, variable, like a combo? Do you do, and then how much do you do to ensure that you've got a fixed amount at a reasonable rate that you're committing to, but allowing for some fluctuation that happens as well? So lots of moving parts. It doesn't have to be all or one. Some people think it has to be fixed or variable. You can do combos.
Is it also depend on where you are too? Because, for instance, in Victoria, there are various property taxes to consider.
Yes, and they're all changing everywhere at the moment as people are getting benefits from first home buyers opportunities, and that's another one to consider going into, again, the new financial year as well. You know, are you doing first home buyers as instead of an investment property? Using your super to take advantage of that strategy, getting more money in, get tax deductions along the way, and then being able to pull it out and put that towards your deposit.
And what if you have a house, perhaps in a regional area, and it might be fully tenanted, or you might have that combination of maybe using it as a holiday let and also using it yourself? How do you actually balance that and work out particularly the tax implications?
Yeah, that one is a tricky one because, you know, it's great if you can use it for holidays. I've got somebody like that at the moment where they're using part of the property and they're renting out the other part as Airbnb. So it's working out with your accountant about what is tax deductible in that, and also managing then future capital gains tax, because we might think in the future, oh, well, I'm just going to sell it for this amount of money and go and buy my next property, but you might still owe some capital gains tax on a portion of that. So again, understanding all those parameters before you commit, and also what structure you buy it in is really important. You know, do you buy it in your own name? Do you buy it in a company structure, a trust structure? Because all of those have different tax implications as well.
Okay, bottom line, I guess, is all about account keeping, isn't it?
Yeah, I'm not an accountant, but yes, go the accountants.